Hey everybody, Kartik Subramaniam over at ADHI Schools. I don't want to make this video political. Regardless of how you feel about the current administration, there's a few things that we as real estate professionals need to know about the proposed tax plan and how it might affect not only the home buying population, but also us as real estate professionals. Now, there's a lot of stuff in the tax proposal. I just want to really dilute this down to a couple of things that you can really use in your day-to-day work as a real estate professional. The first thing is that right now, according to Section 121 of the Internal Revenue Code, now this passed in 1997 under Bill Clinton, if you live in your home as your primary residence for 2 years out of the last 5 years, if you're single, the first $250,000 in gain, tax-free. If you're married, it gets even better. That's weird, married and better in the same sentence. But anyway, if you're married, it gets even better. The first $500,000 in gain, tax-free. You don't pay tax now, you don't pay tax ever. So this encouraged a lot of people to move with some degree of regularity because they could make some money on the sale of their primary residence and pay nothing in capital gains tax as long as it fell under that $250,000, $500,000 rule. The current administration's tax proposal basically would up that. Instead of 2 out of the last 5 years, you have to have lived in your home for 5 years out of the last 8 years under the current iteration of the rule. Now for us as real estate agents, that's bad because it means that people have to stay in their houses longer in order to take advantage of the capital gains exclusion. Now, we don't get paid when people stay in their houses longer. We get paid when people sell over and over and over again. So that could be detrimental to our job as real estate agents. The second thing that's probably important to know, currently homeowners can deduct every dime in mortgage interest up to $1 million. So $1 million home loan, you can deduct every dime in mortgage interest that you pay. That's going to be reduced from $1 million to $500,000. What that means is for people in very, very high, not even very high, because the median sales price in California is like $570,000 today, according to the California Association of Realtors. So for most people buying houses in California, they may not be able to write off all the mortgage interest because mortgage interest is only going to be deductible on this current proposal on mortgage amounts of up to $500,000. But previously, people would be more inclined to borrow more money and buy bigger houses, mainly because you found yourself in a position where you could write off more of the interest. Now that's reduced to $500,000 under the current proposal. So I'm not saying the proposal is completely horrible. I'm not saying it's completely perfect, but there are some things in there that we do need to know in order to be fully informed as real estate professionals. Hope this video helped. Don't forget to like it if you like it. Subscribe to the channel. I'm trying to do a new video every day here, so I want you to be first to know when a new video comes out. Also, I'd love to connect with you on Instagram. My information's on the screen. I'd love to get to know you better, and we'll catch you guys on the next video.